Okay, let's just dive right into this. We're looking at a staggering, almost incomprehensible number today: $37 trillion. That is the current estimated scale of the United States national debt. Today, we're going to dig into the facts together and figure out exactly how this happened, who actually holds this massive bag of debt, and what it really means for the entire global financial system. America owes an extraordinary amount of money. But the real question isn't simply how big the number is. It's what happens when the cost of servicing that debt begins competing with everything else the government wants to spend money on. That right there is the absolute core of our investigation today. We really have to reframe how we think about this whole thing. We need to move past the initial shock of that massive number and look at the real-world mechanics of a squeezed government budget. So let's start with Section 1, the origins of U.S. debt. The American financial foundation was actually built almost entirely on borrowing. Right from the start in 1790, this young nation assumed massive war loans, proving early on that debt was kind of the engine of expansion. Then, jumped in 1944 at Bretton Woods. The global financial system was anchored to the US dollar, which in turn was anchored to gold. But 1971? That is the massive pivot. President Nixon essentially severed the dollar's link to gold. Overnight, the whole system relied purely on global confidence. Fast forward to the crises of 2008 and 2020, and we really see how this modern setup allowed the government to create immense credit to manage, frankly, historical emergencies. And the sheer velocity of this recent spending is literally breathtaking. Since 2020, $4.7 trillion has been spent just in response to the pandemic alone. That emergency spending pushed the debt-to-GDP ratio to an incredible 124.3% by 2024. So the debt isn't just growing anymore, it's accelerating exponentially to fight these massive, once-in-a-generation crises. Moving right along to Section 2, the mechanics of U.S. borrowing. Let's clear up a huge misconception right out of the gate. The annual budget deficit is simply the yearly shortfall. It's kind of like overspending your paycheck for the year. The total national debt, on the other hand, is the accumulated total of all those past deficits added together over decades. Basically, it's your entire life's credit card bill. Every single year the government runs a deficit, it just gets piled onto that mountain. So how exactly do they fund those deficits? Well, through U.S. Treasury securities. When you buy a Treasury bond, you are essentially buying a piece of the U.S. debt. And because the U.S. dollar is used in 90% of global foreign exchange transactions, the international demand for these bonds is absolutely immense. They basically act as a global reserve asset. Think of them as the ultimate safe haven for banks, pension funds, and foreign governments all over the world. Which brings us to Section 3. Who owns America's debt? Now, here is where it gets super fascinating. Based on late 2025 projections, roughly 70% of this debt is held domestically, while about 30% is held by foreign investors. And that domestic 70%, it's largely held by institutions you probably interact with every single day. We're talking mutual funds, local governments, and Social Security, which holds almost $3 trillion itself. Actually, scratch that assumption that foreigners own it all. The single largest holder is literally the U.S. Federal Reserve. But what about that foreign 30%? Well, the top foreign holders include Japan with over $1 trillion, followed by China at $759 billion, and the UK at $723 billion. But if we look beneath the surface, there's a huge structural shift happening. Foreign central banks are actually pulling back on buying US debt, while private foreign investors, like highly leveraged hedge funds, are buying way more. So the debt is shifting into much more price-sensitive hands. If you enjoy documentaries that uncover the hidden forces behind money, power, and global politics, subscribe to Golden Fern. Every week, we investigate the stories that shape the world beyond the headlines. All right, Section 4, the interest cost squeeze. Guys, this number is an absolute wake-up call. $892 billion. That is how much the United States paid simply in interest on its debt in 2024. To put that into perspective, that single annual interest expense is now higher than the entire U.S. military budget. No way around it, we are currently spending more to service past debt than we are to defend the country. And the escalation here is just staggering. Back in 2020, interest payments were $345 billion. By 2023, they jumped to $659 billion. And then in 2024, they hit that $892 billion mark. When Treasury yields rise, the cost to the government absolutely skyrockets. And remember our hook from earlier?
When interest costs consume this much of the budget, it severely restricts what the government can spend on things like infrastructure, healthcare, or, responding to the next big crisis.
Now, economists fundamentally disagree on how sustainable this whole situation is. On one side, you have mainstream economics, which warns that high debt crowds out private investment and risks a severe fiscal crisis. On the flip side, modern monetary theory, or MMT, argues that a country borrowing in its own currency isn't financially constrained in the traditional sense, and that they can use taxes primarily just to control inflation. We definitely aren't taking a side here, but understanding this academic divide is absolutely crucial to making sense of the headlines. Okay, Section 5. What if the debt keeps rising? Economists generally model 3 potential scenarios. And keep in mind, these are strictly hypothetical scenarios, not guaranteed predictions. First, economic growth remains incredibly strong, naturally outpacing the debt burden. Second, rising interest costs force some really painful tax hikes or severe spending cuts. And third, a severe loss of international confidence causes massive financial market disruption. If the world loses confidence, we enter a massive fog of uncertainty. We actually saw hints of this when Moody's downgraded the U.S. outlook or during those intense moments of political brinksmanship over the debt ceiling. Because Treasury bonds are the bedrock collateral of global finance, a sudden spike in risk perception could disrupt global markets practically overnight. Finally, Section 6. Can America pay it off? So can America actually pay off its debt? Well, we really have to separate your personal bank account from the federal government here. A household must eventually pay its debt down to zero, or it goes bankrupt. But a sovereign nation, especially one that prints the world's reserve currency, operates completely differently. It relies on rolling over old debt into new bonds, basically indefinitely. The last time the U.S. had exactly zero debt was all the way back in 1835. Paying off all $37 trillion today would essentially eliminate the safest asset in the entire global financial system. America's debt may be measured in trillions of dollars, but the real story is about something much bigger: confidence. As long as the world continues to trust America's financial system, the debt remains manageable. But if that confidence ever changes, the consequences could reach far beyond Washington. If you enjoyed this documentary, subscribe to Golden Fern, like the video, and tell us in the comments which global story we should investigate next. Thanks for watching, and we'll see you in the next documentary.